Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Wednesday, the 26th of March, 2025. So as usual, let's have a quick look at the disclaimer first before we jump straight into today's gist of Daily Dose of Market Insights. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection made in this presentation is not necessarily indicative of the future. This presentation is not author. Give me a minute over here. I think my screen is hand. All right, this advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the intraday technical outlook of the broad-based cross asset classes, let's have a quick review what has taken shape yesterday in terms of news flow, economic data releases, as well as their respective impact on the broad-based cross asset classes. So there are a couple of conflicting news flow and event that taken shape yesterday. So let us start with this very important leading economic indicator for the US, which is the conference board. All right, the conference board consumer confidence. Okay, so let me expand my screen so that you guys could have a better view. Yeah, this is the one, conference board, right? So why consumer confidence is very important in the US? So we know that close to 3/4 of US economic growth is being driven by the services industry, i.e. retail spending. In order for retailers to spend, consumer got to feel confident, right? If they don't feel confident, even retail spending in the US will deteriorate. And we know that retail activities constitute to 3/4 of GDP growth in the US for the past, 20 or 30 years or so. That could actually see an economic slowdown down the line. And given that consumer confidence is a leading indicator, that means it gives us a head start, indicating to us that whether GDP growth will weaken, expand, or deteriorate. And yesterday, Conference Board announced their latest data for the month of March. So we know that consumer confidence, there are two agencies that actually compile consumer confidence, slightly different in the way they poll the respondents. One is done by Conference Board, which they released their data yesterday. Another one was about 2 or 3 weeks ago, done by University of Michigan. All right, so the Conference Board one also in line with the respondent that is being surveyed by the University of Michigan consumer confidence report done 2-3 weeks ago. That all right, so it showed that for the March consumer confidence data surveyed by a conference board or being compiled by conference board deteriorated to 92.9 from 100.1 that was actually printed in February. Yeah, in February, below expectation of 94. So if you look at the conference board, we call it the website, they actually give us a chart of this consumer confidence index. So this deterioration over here, this steep fall, right, actually broke the series of support that was being seen in 2022, and this level now is the lowest level since 3 years. It's a 3-year low over here, by plunging to this 99, we call it 92.9. All right, so this plunge itself is actually considered by what we call a 4th consecutive month of deterioration. All right, over here. So, but most importantly, this steep fall, it broke below this key support level that you could see on the chart over here, the consumer confidence index chart. And every time this steep fall in the past, right, when it broke below the previous swing low, the US economy slipped into a recession. Okay, that was in 2020 during the pandemic, and over here during the 2008-2009 great financial crisis as well, when it started to register this steep decline prior. All right, so this steep decline over here has starts to see right now, okay, as based on yesterday's conference board data print of 92.9. All right, so this gives us a warning sign that the US economy may be now slipping into a risk of a slowdown, and perhaps we could start to see a recession down the line as well. So what does it mean in terms of corporate corporate profitability. So we talk about US S&P earnings, forward earnings is still rosy. Why? Because market analysts hasn't really yet priced in a potential economic slowdown. And the reason why this conference board consumer index is slipping now and showing prelude signs of what I call economic deterioration or economic recession in the US is due to this very erratic and as well as aggressive trade tariffs policy that Trump's administration or the US White House administration wants to administer going forward over here. And even the key officials in Trump's administration, the Secretary of Commerce, the Secretary of we call it Finance, or the Treasury Secretary, has really kind of pre-warned market participants, saying that they are actually in line with Trump's train of thought, saying that there could be a bit of pain to the US economy, or we call it adjustment, given this kind of trade tariffs policy that they want to engage. That means, i.e., forcing US trading partners to shift their manufacturing hub back to US itself. All right, so there could be a bit of what we call adjustment that could cause this kind of economic slowdown to the US, and invite potentially there could be a stagflation risk as well. Right, so the dollar actually traded sideways from there. What you could see over here is that the US dollar itself traded sideways yesterday after this news. I mean, it's trading sideways over here. And what's interesting over here is that if we were to look at the 10-year US Treasury yield, has starts to rebound and trade back above the 200-day and the 20-day moving average after rebounding from the 4.16 medium-term pivotal support, as per highlighted on my chart over here. Right, so the US we call it Treasury bonds market has starts to react accordingly by stating that going forward there could be a risk of stagflation scenario coming into play. That means, i.e., longer term inflation growth will be kind of on the upward move that causes the 10-year Treasury yield to actually bounce itself, to stage a bounce. But however, the US stock market continues to ignore this risk of stagflation and continue to push higher. So the SPX managed to have a gain of 0.16% over here. All right, so look at the SPX. Okay, there was actually a last minute push up, but initially the SPX opened very weak. Okay, after the release of that rather clear deterioration sign of consumer confidence as being compiled by conference board, which I highlight to you the chart earlier. And during the last hour of trading, there is a steep bounce, and this steep bounce is being led by the NZD 100, right? The NZD 100 over here, where before the last hour, the NZD 100 has started to bounce off earlier, much earlier at the 2 a.m. Singapore time. All right. So what you could see over here, there's still form of optimism in the mega cap stocks, stating that now is deemed as a cheap price because prices has fallen more than 10% from its all-time high that was printed on the NZD 100. So the NZD 100 has then managed to lead by 0.53%. The Dow Jones Industrial Average unchanged, 0.01%. But the Russell 2000 that is representing the small cap company in the US that derive most of their revenue that is tied with a direct correlation with the health of the US economy doesn't join in the rally. In fact, they underperformed by negative 0.66%. So what we could see over here is that it's a rather lackluster movement on the major US stock indices, that whatever rally that we see yesterday doesn't really show a strong conviction that we are in the start of a new medium-term bullish trend for the US stock market to allow them to print fresh all-time high, because the Russell 2000 does not participate in the rally, and the Dow Jones Industrial Average, which is not heavily weighted to the mega cap technology stocks, show unchanged performance yesterday. All right, so I would say that yesterday rally in the US stock market is not uniform as per se. That means being not uniform, and the Russell 2000 doesn't show any signs of positiveness over here, stating that there's some pockets of market participants are not convinced that this ongoing US stock market rally that's being seen on the mega cap technology stocks on the S&P and the NZD 100 for the past 3 sessions are able to actually see strong legs to form potential new start of a medium-term uptrend phase. All right, so that means there's still a risk that there could this medium-term downtrend on the major US stock indices are still intact, leading to lower lows in the weeks ahead. All right, so this is something I want to highlight to you guys. For oil price over here, oil price yesterday closed sideways, but managed to rebound off from our short-term pivotal support level, short-term pivotal support around the 68 level mark for the West Texas crude oil. Why sideways for the WTI crude oil price? Because there's some positive news stating that some peace agreement has already been agreed between US and Russia, saying that Russia and Ukraine agreed to a ceasefire situation in the Black Sea. All right, not the ongoing 3-year war between the Russia and Ukraine, but given this positiveness, it could be a prelude to a much more broader based ceasefire deal that could come up between Russia and Ukraine and eventually end that 3-year war between Russia and Ukraine itself. So due to this positive news flow over here, that causes oil price to actually close almost unchanged at the end of US session yesterday. Right, and also another news more closer to Asia over here is that we know that in the last 3 months, the Hang Seng Index, the Hang Seng benchmark indices representing the China stock market from the international standpoint has outperformed the US stock market and even the rest of the world, driven by China AI team play. And yesterday there was this news flow from a China big tech company, Alibaba. So Alibaba chairman Joe Tsai, which is a key management of Alibaba, stating that there could be a potential bubble forming in data center construction in China. So that actually also reinforced our view that the benchmark Hang Seng indices is due for a multi-week corrective pullback after 3 months of strong uptrending move itself. So if you look at the price performance of the Hang Seng indices as we're speaking right now is rather lackluster. Yes, they did bounce a bit, a positive 0.4% right now, but this bounce didn't surpass its 20-day moving average as we are speaking, that has been taken out since last Friday on the Hang Seng Index. So I'll touch on more in greater detail when I cover the short-term intraday outlook on the Hong Kong 33 representing the Hang Seng Index. So with that, that actually sum up. Okay, one more particular news data I want to highlight over here in early today Asia session was the release of Australia monthly CPI indicator data for the month of February. So for the month of February, the monthly month-on-month change for Australia inflationary trend dipped slightly lower to 2.4% month-on-month from 2.5% that was printed in January, and also slightly below consensus of 2.5%. So if you look at the trend of the monthly Australia CPI indicator, over here, let me open up the chart. Okay, 1, 2, 3. Yeah, you see them starts to actually plateau off in a sideways fashion since December 2.5%. So it seems to us that ever since hitting a high of 2.7%, it starts to go sideways. All right, so indicating that the inflationary trend on a monthly basis in Australia is not ticking upwards, but rather sluggish between this range of 2.1% to 2.5% since September or August high of 2.7%. So that also may potentially lead to what I call the RBA to starts to think about if global economic growth starts to slow down, they will have more evidence or more data driven, we call it a catalyst to allow them to actually cut rates more aggressively. And don't forget, Australia central bank RBA itself is one of the most or less dovish central bank that has yet to actually engage a decent interest rate cut cycle since last year. So that also causes the Aussie dollar to fall slightly from yesterday's intraday pushback up towards the 63 figure level mark itself. Right, later I'll touch more about that Aussie dollar intraday technical outlook and also one particular Aussie dollar pair to cross pair to take a look at. All right, so with that, that sum up the first segment of today's Daily Dose of Market Insight. Let us now move on to the second segment, which is the intraday technical outlook of the broad-based cross asset classes. But with that, let me expand my screen so that you guys could have a better view of the charts when what I'm going to cover. So let's start with the FX market first, starting with the euro dollar. So the euro dollar actually came down as expected, all right, almost hit our first support level at 1.0765, printed intraday low during the European session yesterday at 1.0785, all right, before it pushed back up in the US session, and thereafter traded back down to the entire US session, and now trading at a rather tight sideways range as we are speaking during today's Asia session. So what you could see over here is that I will have because it hasn't broke below the 1.0765 level, I do not want to tighten my short-term pivotal support to be so tight. So I will have a first resistance level for today, which is US uh, before European session high at 1.0830, but still using 1.0860 as my short-term pivotal resistance level, unless at the start of the European session we do have a breakdown below 1.0765, but hourly close below it, then I will be more confident to tighten my short-term pivotal resistance to 1.0830 to maintain the intraday bearish bias. So for now, still using 1.0860 short-term pivotal resistance on the euro dollar to maintain a intraday bearish bias for today. A breakdown below 1.0765 exposes 1.0730. However, hourly close below 1.0730, which is the 200-day moving average, I think as a similar support level as well, may open up scope for a deeper corrective decline sequence on the euro dollar to expose the next near-term support in first step at 1.0680 slash 1.0660. So this level, if you do the Fibo retracement from the last minor rally up of the low of 28th of February all the way up to the high of 18th of March, which was last week, that confluence with the 50% Fibo retracement as well. All right. However, if price action suddenly have a swift up move and hourly close and a rebound and hourly close above 1.0860, today intraday bearish bias will be invalidated to see a squeeze up towards 1.0910 and even the medium term pivotal resistance zone of 1.0940 slash 1.0970. So that's for the euro dollar, still maintaining that intraday bearish bias using 1.0860 as my short-term pivotal resistance level, unless we have an hourly close at the start of the during the European session below 1.0765, then I could tighten the short-term pivotal resistance to 1.0830 next. What's up next for the sterling dollar? So the sterling dollar continues to trade sideways ahead of today's key event that is pertaining to the sterling dollar. Later I'll cover up. There's two key events that could jot the sterling dollar movement for today. So the sterling dollar going to trade in a sideways range below 1.2980 short-term pivotal resistance level. So still no change, still maintaining that rather a sideways to slightly bearish bias scenario for today on the sterling dollar. First support level to watch out for will be 1.2865. Only a breakdown below 1.2865 may see further weakness to expose 1.2810 next, which also calls from confluence with the 200-day moving average. However, an hourly close and a push up above 1.2980 will invalidate today's intraday bearish bias to see a recovery towards 1.3025 slash 3040. Above it may see 1.31 figure level coming in next. So that's for the sterling dollar. So far the sterling dollar also maintained below the parallel resistance level as depicted by the hourly RSI. So still no change, watching 1.2980 short-term pivotal resistance level on the sterling dollar to maintain that intraday bearish bias, as there will be two key risk events that could shake up the movement of the sterling dollar later today. Later I'll highlight what are these two key events. All right. Up next will be the Asia Pacific currency against pardon me, against the dollar, starting with the Aussie dollar. So the Aussie dollar over here yesterday did a kind of a wild sideways movement. Initially it breached above the 63 level, then thereafter it plunges back down again after the release of that rather lackluster monthly CPI data, and now it's coming back up again, but trading back up again. So what I'm going to do now is that it seems to me that it's now starting to trap inside this sideways range for today. So with that, right, I will have a neutrality stance for now. So very likely that it's going to be a rather boring sideways range kind of formation again on the Aussie dollar, at least on the intraday basis. Okay, so let me put it from here. Okay, so this is nothing much to watch, but later I'll highlight one Aussie cross pair, which has a better technical configuration on the intraday basis. All right, so 63.25 upper limit of the neutrality zone, lower limit of the neutrality zone will be today's intraday Asia session intraday low at 62.80. Okay, so neutral between 62.80 and 63.25 for today on the Aussie dollar, given this kind of rather choppy sideways formation that it may start to actually involve right now for today, at least on the intraday basis. So neutral between 63.25 on the Aussie dollar, upper limit, lower limit 62.80. All right, next up will be the dollar yen. So the dollar yen yesterday, we do have a bearish bias. It hit our support level at 150 figure, 149.55. Now with the hourly RSI turning positive again, shaping a higher low as it starts to rebound, and now sliding above the 50 level mark as well, and hasn't yet hit the overbought region. So with that, this dollar yen for today could do a slightly push up to revisit the medium term pivotal resistance zone 15130/80, which will correspond to the 50-day moving average and the 200-day moving average acting as a resistance level. So with that, we will flip to a intraday bullish bias for today for this residual rebound to take shape on the dollar yen, using 149.55 as my short-term pivotal support level for today. Flip to an intraday bullish bias, 150.75 first resistance level to watch. Above it may revisit of that 15130/80 medium-term pivotal resistance. And this medium-term pivotal resistance could be an inflection level where the bears may reinsert their strength again on the dollar yen. That means the dollar yen may shape a bearish reversal upon hitting this level based on the Elliott wave perspective. So with that, on an intraday basis, because it hasn't hit this level yet, there's some more room to go, we will flip to an intraday bullish bias supported by a positive observation. Right now is seen on the hourly RSI, using 149.55 as my short-term pivotal support level for the residual corrective rebound phase to resume. 150.75 first resistance. Above it sees the medium-term pivotal resistance zone of 15130/80. Only a erupt move and a sudden reversal downwards and the hourly close below 149.55 will invalidate today's intraday bullish bias of that residual corrective rebound phase. Immediately, we may start to see the return of the bears to expose the next near-term support in first step at 148.90. Below it sees 148.20 next on the intraday basis. So that's for the dollar yen, flipping to a intraday bullish bias for today, using 149.55 as my short-term pivotal support level. Up next will be this cross pair that I highlighted earlier, will be the Aussie Kiwi cross pair. So the Aussie Kiwi cross pair yesterday actually shaped the bounce and hit the 200-day moving average. So far, it's been trading in this minor downtrend phase since the high of 19th of February. And what you could see over here is that upon hitting the 200-day moving average, the hourly RSI has shaped that bearish divergence, and it has now exited from the overbought region as well. So with that, using 110.15 level, slightly above a 110 figure level, which is 200-day moving average. So 110.15 on the Aussie Kiwi cross pair correspond to the downward sloping 20-day moving average, and as well as the minor descending trend line from minor descending resistance trend line from the high of 19th of February. So 110.15 short-term pivotal resistance on the Aussie Kiwi cross pair. Bearish bias for today, 109.60 first support level. A breakdown below it exposes 109.14 on the intraday basis, which is the minor swing low of 20th of March and 21st of March. Only an hourly close and a breakout above 110.15 will invalidate today intraday bearish bias on the Aussie Kiwi to see a squeeze up towards 110.40 and even 110.55, which correspond to the 50-day moving average, acting as a similar resistance as well. So one particular interesting cross pair to watch out in terms of trade, in terms of technical analysis outlook on the intraday basis, because it's actually right now turning down right exactly as an inflection point, which is the 110.15 short-term pivotal resistance on the Aussie Kiwi to have a intraday bearish bias for today. Right, so that sum up the intraday technical outlook on the FX market. Moving on will be the intraday technical outlook on the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So Hong Kong 33, yesterday we have a bearish bias using 23,960 as my short-term pivotal resistance. Price action indeed slide down lower, printed a series printed another lower low, almost hit our first support level at 23,250. So yesterday during the European session, it printed 23,315, and right now during the Asian session, it attempt to recover but can't recover, and it shaped a lower low. Okay, what I could see over here, and below the 20-day moving average. Okay, still trading below the 20-day moving average. Now resistance at 23,740. So since it haven't broke down below our first support of 23,250, I do not want to be so aggressive and tighten the short-term pivotal resistance to that 20-day moving average, acting as the resistance level as well at 23,740. So this will be my first resistance level to watch, 23,740, still using 23,960 as my short-term pivotal resistance level on the Hong Kong 33, representing the Hang Seng Index. Only a breakdown below 23,250 exposes 22,980 next, and if, below it may see 22,470 coming in, which is the minor swing low of 17th of February, 20th of February, and as well as 4th of March. All right, only we have an hourly close thereafter during the Asia's later part of the Asia session. Then below 23,250, then I'll be more confident to tighten the short-term pivotal resistance to 23,740. So still, for now, still no change. Still using 23,960 as my short-term pivotal resistance level to maintain that intraday bearish bias on the Hong Kong 33, representing the Hang Seng Index. Next up will be the Japan 225, representing the Nikkei 225. So price action still hover below the pivotal resistance zone at 38,325/490. So still no change using this pivotal resistance zone in short term, 38,325/490 to maintain that intraday bearish bias within this complex sideways range of the Japan 225. First two near-term resistance support level to watch, on the intraday basis will be 37,595 followed by 37,380, which correspond to the 20-day moving average, acting as very closely to a similar support level as well. However, if we start to see an hourly push up and a close above 38,490, that would invalidate today's intraday bearish bias to see a squeeze up to prop further the next resistance zone at 38,760/38,880. Right, so that's for the Japan 225. Still maintain that intraday bearish bias below 38,325/38,490. Next up will be the German 30, representing the German DAX. So the German 30 and German DAX push up to yesterday's upper limit of the neutrality zone before it actually trade back down and traded during the start of the US session. Then thereafter it's just trade sideways again, not very tight. So now in the Asia session, it's now looking to retest the 23,180 level. So given that this is a rather illiquid movement for the German 30 right now, because the futures market is not yet open, the futures market only be open at the start of the European session at around 3 p.m. Singapore time. So with that, no clear cut of price action for today in today's Asia session, we'll still maintain that that neutrality stands on the intraday basis for today. 23,180 upper limit followed by the lower limit at 22,740, only an hourly close during the start of the European session at 23,180, then that could validate a bullish move or bullish exit from this neutrality zone on the German 30 to expose the next near-term resistance at 23,360 followed by 23,600/23,660. So for now, still maintain that intraday neutrality stands for now, but watch the upper limit of the neutrality zone at 23,180. Right, so that's for the German 30. Next up will be the major US stock indices, starting with the Wall Street 30, representing the Dow Jones Industrial Average. So like I mentioned, the Dow Jones Industrial Average yesterday closed almost unchanged. So it actually didn't break above our first resistance level at 42,690. So still no change. And the hourly RSI starts to print a lower high. Okay, a lower high, representing lackluster upside momentum observation on the shorter term basis on the US Wall Street Index, representing the Dow Jones Industrial Average. So still no change, still using the 42,980, 43,120 short-term pivotal resistance level, maintaining that intraday bearish bias for the US Wall Street 30, at least for a minor corrective slide on the intraday basis in first step to revisit the 200-day moving average and the 20-day moving average, acting as a similar intermediate support zone at 42,250. Then I'll slash it 0.55, which is Monday's gap up All right, so this will be the first support level to watch in today's intraday bearish bias for the US Wall Street 30. Only a breakdown below 42,055 potentially will start to see a deeper slide towards 41,700 / 41,450 next. However, if price action starts to see a squeeze up and the hourly close above 43,120, today's intraday bearish bias will be invalidated to see a squeeze up towards 43,460, which is the 50-day moving average acting as a resistance, and as well as this dotted red line over here, which was the former major ascending channel support from the low of October 2023. 2023 now turns into a significant major pullback resistance level as well at the 43,460 level. All right, so for now, still using 42,980, 43,120 to maintain that intraday bearish bias on the US Wall Street 30. Next up will be the NZD 100. So the NZD 100 continues to push higher and test our 20,340 short-term pivotal resistance level, which is so the 200-day moving average. So with that, what we could see over here is that the price action on the hourly RSI has started to clearly print out a bearish divergence. Okay, so price action show higher high, but the hourly RSI is not showing higher high, but in fact showing a bearish divergence. All right, it's sloped downwards at the overbought region. So what it means that upside momentum is also getting lackluster on the NZD 100 yesterday. So with that, still using 20,340, indeed that is our short-term pivotal resistance level, still maintaining that intraday bearish bias. So the low first support level to watch will be yesterday's European session low, which is at 20,120, right? 20,120. Okay, so that will be the first support level to watch out for today. 20,120, very closely to the 200-day moving average as well. A breakdown below 20,120 exposes the former minor range resistance now turns into a pullback support level at 19,915 / 770 will be Monday's gap up support level. Right, so maintaining that intraday bearish bias because of that bearish divergence that's being seen on the hourly RSI, indicating the lack of upside momentum on the short-term basis. Still using 20,340 as my short-term pivotal resistance level to maintain the intraday bearish bias on the NZD 100. First support level, we tidy up slightly to 20,120. A breakdown below 20,120 increases the chance of a further slide to revisit 19,915 / 770 on the intraday basis. However, an hourly close and a push up above 20,340 will invalidate today's intraday bearish bias to see the continuation of this rebound, exposing the next resistance at 20,700 / 20,790 next. So that's for the NZD 100. Next up will be the commodities market, starting with gold XAU / USD. So gold XAU / USD continues to remain lackluster. Yesterday, it tried to shape a push up, but can't break above our pivotal resistance that we highlighted earlier at 3,380. And what we could see over here is that the hourly RSI has started to print a lower high. And right now, it attempting to break a parallel trend line ascending support level as well. Okay, over here. It's attempting to break this parallel ascending trend line support, right, indicating the lack of upside momentum, all right, on gold XAU / USD on a shorter term basis. So still no change, using 3,380 as my short term pivotal resistance for today. Still maintaining that intraday bearish bias. First support level equal to breakdown will be 3,000. Below it exposes 2,978 and even 2,953, being the upward sloping 20-day moving average, and as well as the lower limit of this minor ascending channel that I drew from the low of 28th of February. Right, so that's for gold XAU / USD. However, a price action breakup and hourly close above 3,038 will invalidate today's intraday bearish bias to see the start of an impulsive up move to retest the current all-time high at 3,058 in the first step before looking up towards the next higher near-term resistance zone at 3,076 / 3,090. So for now, still using 3,038 short-term pivotal support. Yeah, I repeat, still using 3,038 short-term pivotal resistance to maintain that intraday bearish bias on gold XAU / USD. Lastly will be the West Texas crude oil. So West Texas crude oil yesterday, it closed unchanged, but however, it managed to shape a bounce and form a higher low. okay, a higher low over here above the 20-day moving average. So with that, this bounce also managed to bounce out from the former minor range high of 18th of March and 21st of March, now turns into a clear pullback support level. So with that, I will have a Titan key short-term pivotal support level for today for West Texas Oil using 68.77 as my short-term pivotal support level. Titan short-term pivotal support at 68.77. Short-term pivotal support for West Texas Oil, still maintaining that intraday bullish bias for this ongoing corrective rebound phase to play out within a major descending triangle range configuration. Next resistance level to watch will be 70.80. Above it may see 71.45 coming in next, which is the minor swing high area of 25th of February and the downward sloping 50-day moving average. However, an hourly close below 68.77 short-term pivotal support level will invalidate today's intraday bullish bias to see a slight re-exposing the 20-day moving average at 68 figure level. However, a breakdown below 68 figure level will see a choppy further downward drift to expose 67.05/66.45 next. So i.e. still maintaining that intraday bullish bias with a tightened short-term pivotal support for today at 68.77 for West Texas Oil. So that also sum up the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for? Still, I recall that today there will be two key risk events that could impact the sterling dollar movement. So what are these two key events? Will be the inflation rate, core inflation rate from UK out at 3 p.m. Singapore time. So market is expecting a slight dip to 3.6%. From 3.7% year on year that was printed in January. So if the consensus, if the actual number came in way below consensus at 3.5 or 3.4%, that could increase the odds to allow Bank of England to have a much more dovish monetary policy stance, guiding their monetary policy going forward. So something to look out for today at 3 p.m. Singapore time, the release of the core inflation rate for UK. And also for today, roughly around 4 p.m. to 5 p.m., the finance minister in UK will develop its spring economic statement to the UK Parliament. Over here, the finance minister, they call it Chancellor in UK. The UK Chancellor will develop her latest spring economic statement in UK Parliament. So market is expecting a downgrade of economic growth in UK itself. So that could also potentially sway going forward the monetary policy engagement that is being done by Bank of England going forward. So something to look out for, right? During between I think 4 p.m. to 5 p.m. Singapore time. All right. So with that, then during the US session, let me see during the US session, is there other key data to look out for? So there's no tier one data from US for today, except for two key officials speaking, Federal Reserve officials speaking, Fed Kashkari at 10 p.m. Singapore time and 10:10 Fed Musalam. And for those who are looking at the West Texas crude oil, we do have that weekly EIA agency weekly crude oil stockpile change that will be released at 10:30 p.m. Singapore time. All right. Then during tomorrow early Asia session, at 9:30 a.m. we have one China data, which is the industrial profits year to date industrial profits, but they are looking on the year-on-year basis. So market participants will be looking at will there be an improvement. So a forecast by trading economics, they're looking at an improvement of 4% from previous month of negative 3.3% year-on-year. All right, so something to look out for. So that should sum up today's daily dose of market insights. I'm Kelvin here signing off. A quick heads up, tomorrow I'll be off for a medical appointment in the morning, so there'll be no daily dose of market insights tomorrow, and daily dose will resume again on Friday, on this Friday, 28th of March. So with that, do have a great day ahead, and we shall speak again on Friday. Thank you.